fundamental partnership chapter. The second chapter is the valuation of goodwill, and here it is very important for us to know what are the methods of valuation of goodwill. Apart from doing the theory part, which is given in every textbook, it is very important for us to know the sums, and that will be done by knowing the methods of valuation. There are three methods of valuation of goodwill. Number one, average profit method, which is further divided into simple profit and weighted average profit method. Both of this has been done in this video. Numerical examples has been taken to explain the concept, and we have also done the super profit method in this video. In my next video, we'll come up with the capitalization method, and that will be further divided into capitalization of average profit and capitalization of super profit. Keep watching my videos. Don't miss any of the lectures. The second video will be uploaded soon. Now let us read the first question and see how it is valued. So the first question says, calculate the value of goodwill if it is valued at 5 years purchase of the average profit of the last 4 years. Reading the question only will understand that what the question is asking us to do. The question is asking us to calculate the value of goodwill which is valued at 5 years purchase of the average profit. So we will do two steps. Step number one, we'll calculate the average profit. How can that be done? Add the 4 years profit which has been given to us. See very carefully, the 4 years profit has been given to us as 60,000, 56,000, 44,000 and 80,000. Take a total of that and divide it by 4. So 2,40,000 divided by 4 gives us 60,000 as the average profit. Multiply the average profit with the years of purchase. Here the years of purchase is 5 years. So therefore the value of goodwill is 60,000 into 5, which becomes 3 lakhs. Now the next question talks about the adjusted average profit method. The profit for the last 4 years ended 31st March, where 31st March 2014 1,60,000, 31st March 2015 a loss of 60,000 is given in a bracket. Always remember, whenever any data is given in bracket, it signifies the loss. 31st March 2016 48,000 profit, and 31st March 2017 72,000 profit. The profit of 31st March 2014 include winning from lottery 1 lakh rupees. Now this winning from lottery has caused the profit of 2014 to be inflated, because lottery income should not be shown in the profit and loss account because it is not a regular income. On 1st April 2014, a new machinery was purchased for 1 lakh, on which the depreciation is provided every year at 10,000. Calculate the goodwill if it is valued at 2.5 years purchase of the average adjusted profit. See very carefully, there is a mistake over here. In 2014 also, a new machinery which was purchased for 1 lakh, it was shown in the profit and loss account, and that is the reason why the profit has actually gone down. In fact, it has turned into a loss of 60,000, and every year there is a depreciation of 10,000 to be provided on the machinery, and we are asked to calculate the goodwill at 2.5 years purchase of the average adjusted profit. It's very clearly stated, average adjusted profit. So we first have to make an adjustment table which has been shown very clearly to you, and there we have adjusted the profits. See very carefully, the first column has the profits of all the 4 years given to you. 1,60,000 profit for 2014, 60,000 loss for 2015, 48,000 is the profit of 2016, and 72,000 is the profit for 2017. Less lottery. 2014 you have seen there is a lottery income which should not be over there, so we have subtracted that, add machinery purchased 1 lakh, which has been added because that has caused the profit to come down, and less depreciation all the 3 years 2015, 2016 and 2017. I hope it is very clear. Since the machinery was purchased on 1st April 2014, the full year's depreciation will be charged in the year 2015, that is year ended 31st March 2015, and the subsequent years 31st March 2016 and 31st March 2017 respectively. After doing this calculation, we are getting the adjusted profit as 60,000, 30,000, 38,000 and 62,000 in the year ended 31st March 2014, 31st March 2015, 31st March 2016 and 31st March 2017 respectively. Now we will first calculate the average of these 4 years. So we have first added 60,000 plus 30,000 plus 38,000 plus 62,000 to get us a figure of 1,90,000. Divide that by 4 because 4 years profit is given to us, which will give us a figure of 47,500. We have seen this. This is the step 1 to calculate the adjusted profit, and finally the step 2 is to calculate the goodwill by multiplying the adjusted profit, which is 47,500, by the years of purchase. What is the years of purchase? 2.5. So it comes to 1,18,750. How did we get that? 2.5 into 47,500. After the simple average profit method, now let us see the sums based on the weighted average profit method. First, let us understand what do you mean by weighted average profit. See very carefully, it is an extended version of the average profit method where weights are assigned to each year's profit. This method can only be used when profits over a period is showing a trend. Trend means either it is increasing over a period or whether it is falling over a period. So rising trend or falling trend should be there. The highest weight is assigned to the most recent year. So if 4 years profits are given to you, 2014, 2015, 2016 and 2017, 2017 will have the highest weight and 2014 will have the lowest weight. Always remember that. So it will always be the most recent year having the highest weight. Now I have taken 3 cases and I'll explain to you where the weighted average profit will be used and where the weighted average profit will not be used. See very carefully. In the first case, the profit of 4 years, 2017, 2018, 2019 and 2020 is given to you as 20,000, 24,000, 36,000 and 60,000. So you can see that there is an upward trend. The profit is increasing every year. Repeat again, the profit is increasing every year. It is increasing from 20,000 to 24,000, then to 36,000 and finally it has increased to 60,000. So there is a trend, rising trend. In the next case, we have seen the profits of the 4 years. The first year profit was 60,000, second year it is 54,000, third year it is 46,000 and finally the fourth year 40,000. So you can see the profits are falling down in this case each year. So in both these scenarios, above 2 cases, we can use the weighted average profit method. Why? Because it is showing a trend. However, in the next example, you can see the first year's profit is 50,000, next year's profit is 24,000, then it increases to 86,000 and again falls down to 60,000. Here, we cannot use the weighted average profit because it is not showing a trend, either increasing or decreasing. Now, what is the formula for calculating the weighted average profit? Very simple formula. Weighted average profit is equal to total of the product profit divided by total of the weights. So we have to find the products divided by total weights. Up till now in average we were dividing by number of years, but here we will be dividing with the total of weights. And how is goodwill ascertained? Like before, goodwill is ascertained by the value of average into the number of years of purchase. Always remember, years of purchase will be given to you and you will multiply it with either the average profit or the weighted average profit to find the value of goodwill. Now let us take an example to understand this method. So you can see that profits of 4 years 2017, 2018, 2019 and 2020 is given to you as 18,000, 24,000, 30,000 and 36,000, and the weights have been assigned for these years as 1, 2, 3, 4. These are the weights which has been assigned. Calculate the value of goodwill if it is valued at 5 years purchase. Now the years of purchase is given to you as 5 of the weighted average profit. See very carefully what we are doing. We are making the following columns: years, profit, weight and product. How do you get the product? Profit into the weight gives you the product. So first year the profit was 18,000 and the weight was given as 1, so the product becomes 18. Second year the profit is given as 24,000 and the weight is 2, so the product becomes 48. Third year 30,000 into 3 becomes 90. Fourth year 36,000 into 4 becomes 144. Now if you add the total of the products, that is 18 plus 48 plus 90 plus 144, that gives you a total profit of 3 lakhs. Next, find the total of the weights. The total of the weights 1 plus 2 plus 3 plus 4 is 10. Now to find the weighted average profit, divide the product and the weight. So 3 lakh divided by 10 gives you 30,000, and the question has given us 5 years of purchase. So 30,000 into 5, the goodwill will come to 1,50,000. Now let us go to this question, which is a combination of average adjusted profit and weighted average profit. So let us first read the question. We are given the profits of 3 years ended 31st March. So 31st March 2018 there was a profit of 1 lakh. 31st March 2019 there was a loss of 60,000, and 31st March 2020 there was a profit of 90,000. We are also given additional information that the profit of 31st March 2018 include 40,000 which was a win from lottery. So that should be subtracted because it is not a regular income, and it should be subtracted to get the corrected profit. Moreover, on 1st April 2018, that means beginning of 2019 year, what actually happened was you have purchased a machinery for 1,40,000 and that has been shown in the profit and loss account. As that has been shown in the profit and loss account, the profit of the year has actually turned into a loss of 60,000. So 1,40,000 needs to add it back. Okay, and therefore if we add it back, we will get the correct profit as 80,000. And there is no information given about 2020. Therefore 2020's adjusted profit itself is the correct profit, that is 90,000. So now after the adjustment we have got the profits at 60,000, 80,000 and 90,000 respectively. Weights of the 3 years are given to us as 2, 3 and 5. And we are asked to calculate the goodwill at 2.5 years purchase. So first, with the adjusted profit, let us multiply the weights 2, 3 and 5. So 60,000 into 2 will give you 1,20,000, 80,000 into 3 will give you 2,40,000, and 90,000 into 5 will give you 4,50,000. So if you add 1,20,000 plus 2,40,000, 3,60,000 plus 4,50,000 will give you 8,10,000. Now 8,10,000 divided by 10, how did I get 10 over here? 2 plus 3 plus 5 is 10. So 8,10,000 divided by 10 is 81,000. This is the weighted average, that is 81,000. And now how many years of purchase is given in this question? 2.5 years purchase. So 81,000 into 2.5 gives you 2,02,500, which is the goodwill in this case. Now let us understand the next method. The next method is called the super profit method, and whenever we are calculating goodwill using the super profit method, we first have to understand what is super profit. Super profit is nothing but the excess of average profit over normal profit. So you can see very clearly over there that the formula is average profit minus normal profit is equal to super profit. Now, how is normal profit calculated? Normal profit is calculated using the formula capital employed into normal rate of return. Repeat again, capital employed into normal rate of return. So normal rate of return is always given in percentage. So that is the reason why you can see the denominator is 100 over there. Now, next question is, how is capital employed calculated? Capital employed is calculated using two formulas. Either it is calculated from the asset side of the balance sheet or it is calculated from the liability side of the balance sheet. If we take the liability side of the balance sheet, then the sum total of the capital, which includes the capital as well as the current account, reserves and surplus and the profit, will form the capital employed. On the other hand, if we move from the asset side, we can take the value of capital employed as assets minus external liabilities. Remember, only one of the methods will be used in the sum depending upon what data is given to us. And normal rate of return will always be given in the question. It may be given as the interest of, or the profit is earned at a normal rate of, and the percentage will be mentioned to you. Now let us do the first question involving the super profit method. Profit of the last 5 years were 27,000, 39,000, 22,000, 31,000 and 21,000. Capital invested is 1,80,000. Normal rate of return, which is also mentioned as NRR in many questions, is given as 10%. Calculate goodwill if it is valued at 3 years purchase of average profit, 3 years purchase of super profit. Now this question gives you a clear understanding of the average profit as well as the super profit. So let us see what is the difference between both. Now step number 1, calculate the average profit. We already know how we calculate the average profit. That is clearly done by adding the profits given, dividing by the number of years. See over here, we have added 27,000, 39,000, 22,000, 31,000 and 21,000, the profits which were given to us, and divided by 5. So we are getting 1,40,000 divided by 5, 28,000 is the average profit. Now the second step is to calculate the normal profit, because whenever we are asked to calculate the super profit, we need both normal profit as well as the average profit. So the normal profit is capital employed into normal rate of return. See, the capital employed is 1,80,000 into 10 by 100, which gives you 18,000. Repeat again, 1,80,000 into 10 by 100, which gives you 18,000. So now we have both. We have the average profit also and we have the normal profit also. Step number 3, we'll calculate the super profit by using a simple formula, that is average profit minus normal profit, 28,000 minus 18,000, which gives us 10,000. Now seeing the first question, 3 years purchase of average profit. What is the average profit? 28,000. We have calculated at the top, you can see it, multiplied by 3, 84,000. So it is the goodwill in the first case. What will be the goodwill in the second case? It is given as 3 years purchase of super profit. What is the super profit? See very carefully, step number 3. We have already calculated super profit as 10,000. So 10,000 into 3, 30,000 becomes our goodwill using the second method, that is 3 years purchase of super profit. Now we'll do the second question involving the super profit method. Average profit of last few years is given to us as 64,000. The average profit is already given to us here. We don't have to calculate it. The balance of the capital accounts of A and B. Here two partners capital account balances are given as 1,60,000 and 1,40,000 respectively. The normal rate of return is given as 15%. We are asked to calculate goodwill if it is valued at 5 years purchase of super profit. So we'll follow the same steps. Step number 1, calculation of average profit. Here it is not required because average profit is given to us. Step number 2, calculation of normal profit. We have to do it because the capital of two partners are given to us and the normal rate of return is given to us. So the sum total of two partners is 3 lakh and I'm finding out 15% of 3 lakh, which is coming to 45,000. So now we are calculating the super profit, that is average profit minus normal profit. 64,000 minus 45,000 gives us over here 19,000. Therefore, the super profit is 19,000 and the goodwill is valued at 5 years purchase. So 19,000 into 5, 95,000 will be the value of goodwill using 5 years purchase of super profit. Let us take another question. Here, the assets of a firm is 10,28,000 and its external liabilities was 2,78,000. This will help us to calculate the capital employed because we know that asset minus liability will help us to get the capital employed. The normal rate of return in this type of business is 12.5% and the average profit is 1,20,250. So see very carefully, here the average profit is already given and we don't have to calculate the average profit. Calculate goodwill if it is based on 2.5 years purchase of the super profit. So what is the step 1? Calculation of average profit. We don't have to do it because it is already given to us, 1,20,250. Step 2 is calculation of normal profit. We have done it by the capital employed into the normal rate of return. See, the capital employed is asset minus liability, that is 10,28,000 minus 2,78,000, which gives us a value of 7,50,000. 7,50,000 into 12.5 by 100 gives us a value of 93,750. So we have got the average profit and we have got the normal profit. Now the step 3 is calculation of super profit, where we are subtracting the average profit and normal profit already calculated. 1,20,250 minus 93,750 gives us a figure of 26,500 and we are told to calculate goodwill at 2.5 years purchase of super profit, which has come to 26,500 multiplied by 2.5 is 66,250. Therefore, the goodwill over here comes to 66,250.